Welcome to the third in our series of 4 short CPD sessions based around the Mortgage Market Review. As a professional mortgage advisor, you can log 15 minutes as mortgage-related CPD. For other membership categories, this can be logged as My CPD. This session will cover the mortgage advice process. First, we will look at the mortgage sales process. Then we will look at a little more detail around assessing appropriateness. We will have a look at the rules around execution-only business. And finally, we will have a look at some frequently asked questions. So let's first have a look at the sales process for mortgages under MMR. The first thing to note about the sales process is that before any advice is given or any illustrations are given, you must complete the initial disclosure information, and this must be communicated orally and built into the initial discussions with the customer. As we saw in the previous session on disclosure, this should include a description of your services and the range of products, including any limitations in the range of products. You will also need to disclose the basis of your remuneration, whether any fees will be charged to the customer, when those fees will be charged, and whether you will receive any commission from third parties. Most importantly, the FCA have decided to withdraw the non-advised sales process. Therefore, where you are selling mortgage contracts or entering into variations of existing mortgage contracts with a customer, then advice must be given wherever the sales process involves spoken or other interactive dialogue, except for certain circumstances which we will look at later. The regulator doesn't stop you giving pre-contract or preliminary information, which doesn't amount to advice to a particular customer, but they do insist that advice must be given before you enter into or arrange a regulated mortgage contract. The next vital step in the sales process involves understanding the needs and circumstances of the customer. You should take all reasonable steps to obtain from a customer all information likely to be relevant for the purposes of advising on a mortgage contract. The contract will not be considered suitable for a customer unless it is appropriate to the needs and circumstances of the customer. So once you have gathered all the information about the customer's needs and circumstances, you then need to assess the appropriateness of any specific mortgage contract. As we have said, you must decide whether a mortgage contract is appropriate to a customer's needs and circumstances. This should be based on the facts disclosed by the customer and any other relevant facts about the customer which you are or should reasonably be aware of. As well as needs and circumstances, there are 9 factors to consider when assessing appropriateness during the advice process. Let's look at each of these factors in turn. The first and most important of these factors is whether or not the customer meets the eligibility criteria for the lender and also meets the affordability test. Although the onus will ultimately be on the lender to approve affordability, lenders will be increasingly reliant on mortgage advisors to carry out detailed planning and also interest rate tests to illustrate that a client is suitable for a specific product. You will need to be fully up to date with the lender's requirements to ensure that any mortgage application that you submit is appropriate. This requirement not only means that you need to be aware of your client's personal and financial circumstances, but it also means an understanding of the current economic climate and the effect of increasing mortgage rates is required. You will need to make sure you take into account the borrower's net income, including any committed expenditure, and the impact that a rise in interest rates may have on the customer's mortgage repayments. You will also need to carry out detailed forward planning with clients and discuss any possible lifestyle changes that could affect affordability. Lender criteria are also susceptible to change, so you need to stay informed about any amendments that arise which may affect the borrower's mortgage application. Next, you will need to decide whether it is appropriate for the customer to have an interest-only mortgage, a repayment mortgage, or a combination of the two. This decision will depend on the customer's affordability and also access to a suitable repayment vehicle. The third factor is deciding on a suitable term for the customer, dependent upon their needs and circumstances. There could be impending changes in their circumstances, such as retirement, that would affect the term that you would advise. The fourth factor is stability. Does the customer need stability in their payments? If so, perhaps a fixed rate would be suitable for a certain time. And then, depending on their circumstances, would minimizing payments at the outset be a priority for the customer? Would it be appropriate for the customer to make early repayments? And do they have the circumstances that would allow that? Looking across all the mortgages available to you, are there any other features that would be important to the customer? The eighth factor is credit history. Based on the information provided to you by the customer as to their credit history, is the mortgage contract appropriate? And our final factor to take into account is fees. Is it appropriate for the customer to pay any fees or charges in relation to the mortgage contract up front, or would it be more appropriate to add them to the sum advanced? So now we've had a look at the sales process and we've had a look at assessing appropriateness. Finally, we'll have a look at execution-only business. Execution-only business is not a rebranding of the non-advised process, and it must be remembered there's no requirement for you to do execution-only business. For a case to be considered execution-only, the customer must specify certain information about the product. The customer must also be informed of the protections they are losing by doing execution-only business, and the customer must positively elect to proceed on an execution-only basis. One final thing to remember about execution-only before we start looking at it in more detail is that vulnerable customers must receive advice in the first instance. Execution-only sales will be available in a very limited number of circumstances. Firstly, you do not have to give advice and can sell on an execution-only basis where it is a non-interactive sales process, for example a pure online sales process, or by post, where it is not practically possible to give advice. There are certain circumstances where interactive transactions can result in execution-only business. These would be specifically where a customer is a high net worth customer, where they are a mortgage professional, or where the loan is solely for business purposes. And finally, execution-only can be considered where the customer has rejected the advice you have given and wishes to proceed with a product of their own choice. We have now covered the sales process, assessing appropriateness, and execution-only business. There is a lot more detail involved in these, and we would encourage you to visit the FCA website to find out this information. The next few screens contain some frequently asked questions concerning the mortgage advice process. There is no voiceover accompanying the next few slides. So that concludes our session on the Mortgage Market Review mortgage advice process. Remember to record this session against your CPD. The final MMR session will cover the topic of systems and controls, including details of qualifications. As a professional mortgage advisor, you can log 15 minutes as mortgage-related CPD. For other membership categories, this can be logged as My CPD.